Hi, my name's Joe Neighbour from Signal Centre. I am a director at the company. At Signal Centre we provide trade ideas, trading signals and education. This is the first in a series of educational videos that we'll be publishing, and this is on risk management and specifically talking about position sizing. Now first up, just need to run through some risk warnings. We're an FCA regulated firm and obviously take regulation very seriously. If you've been trading FX or leverage products, then you're probably familiar with all of the wording that you see here, but it's important that you understand it and are familiar with our risk warning. So next I'm going to go through the content of what I'm going to go through today. We're going to talk about counting your returns using R. We're going to talk about calculating position sizes, how much you should be looking to risk on a trade, talk about the importance of consistency, and also run through a few tips on how to grow a small account. So first we're going to run through counting your returns using R. This may mean something to some of you and it may have a few of you scratching your head. I'll do my very best to explain this and give you an understanding of how professional traders describe and produce their returns. Now the concept of R, or R multiple, is popular among professional traders. You may have seen professional traders on Twitter using that phrase when they're talking about how much they've made or lost on a particular trade. Now we tend to count our returns using R rather than using pips, and in terms of what R is, it simply means risk, and it means how much you've risked on a particular trade. So it's the difference between the entry point and the stop. That is effectively R. So we're looking to keep our losses to a minimum of 1R on a particular trade, and we're looking to make our gains a multiple of 1R on a particular trade. Now on this chart up here, we've got Euro Yen on a 4-hour time frame, looking to sell at that purple line as a retest of that resistance level. We've got a stop loss up here, 35 pips, and a target down here of 90 pips. So if we are triggered and are successful on that trade, we would have made 2.5R. It's the risk-reward ratio of a particular trade. Now, a number of signal providers, of which there are now many, due to the explosion of them on social media, they'll talk about they make their returns in pips. They'll talk about how many pips they've made in a day, how many pips they've made in a week or a month. Now, we feel this can be quite misleading. We feel talking about returns using R is a much cleaner and simpler way of talking about performance. The thing is, with the signal providers, they may tell you that they've made 300 pips on a particular trade. They did tell you how much they risked in order to make that. So if they've risked 300 pips in order to make 300 pips, that isn't a particularly good trading setup. So a lot of people tend to follow these blind without actually looking at the risk-reward ratio of each of these trades, and that's something to be very important of. So just to reiterate, R is risk. It's how much you risk on a per trade basis. You're looking to keep R to -1 if you're wrong, and if you're right, you're looking to make multiples of R. So if in this instance the trade was correct, we would have made 2.5R. If we had lost, we'd have lost 1R. Now, I'm going to talk about position sizing and how to do it efficiently and to make sure that you keep your trades consistent in terms of your losses and your gains, and making sure that your risk is a defined level according to your trading plan. Now this is talking about position sizing using spread betting. Now I know a lot of you are trading using MT4, therefore you need to calculate lot sizes. I'll come on to that. The calculation for that is a little bit different and a bit more complicated. But just to try and make it easy for you in the spread betting terms to start with, we've got a trade set up here in Euro US dollar. We've got a 20 pip stop on the trade, so our R is 20 pips. We're looking to risk £100. That's our 1R downturn. If we get the trade wrong, we're happy that we've risked only £100 on this trade. So we take £100, we divide it by the stop loss of 20 pips, that gives us 5. Therefore we need to place a trade size of £5 per point on the trade. If the trade goes on to hit our stop loss and we lose 20 points, then that will be equivalent to £100. We've lost 1R on the trade. If the trade goes on to hit our target, we'll make 50 points, and 50 points times 50 is £250, or 2.5R. Now, in terms of how we display this, this is our Euro US dollar trade performance for 2017. As you can see, we've traded 98 times, and over the course of a month, this is a month-by-month breakdown. So we made 1.4R in January, lost 0.72R in April, had a bumper month in August of 7.13R. But the key is we're looking to keep our gains above, obviously, naught. So we made 1.4R, so however many trades we placed in January, we only ever risked 1R per trade, but we're trying to make multiples of R on the outcome. So we've been pretty disciplined, not massively spectacular results, but we've made a gain and we've kept our losses to a minimum, which is the key to trading. Now, talking about position sizes for lot sizes, the calculation is slightly different. So we are risking £100. We still need to take into account the stop loss. So 100 divided by 35. We then need to times it by the instrument that we're trading, and this also depends on what currency your account is in. So you need to take these various calculations into account. So it is complicated, and it can put people off because they'll think it takes too much time to actually work out how much they should be trading in order to keep their losses at a consistent level. If you're worried about that, then I'd urge you to take a little bit of a step back. Don't be in such a hurry or a scramble to get your trades on. Actually take the time to work out how much you should be risking on a per trade basis. It'll keep you in the game much longer, and it will make sure that your gains are much bigger than your losses. Now, there's plenty of free resource around in order to help you with your position sizing. This is one particular website. This is my FX book. I know that you can also get a similar pip calculator from Baby Pips, which some of you may be familiar with. So just to run through this, it will ask you what your account currency is. So in this instance, I'm going to put sterling. My account size is 1,000. I'm going to risk 3% of my account on this trade. I've got a 40 pip stop loss. I calculate that and it tells you how many lots you should be buying or selling, units if you're trading CFDs, and of course highlights to you the monetary risk that you're placing on that particular trade. So check that out. It's a nice tool to have, and it will save you obviously a lot of time going through the manual calculations of that. Now, next we're going to talk about how much you should be risking on a particular trade. I don't have that answer for you. That is down to each of your own personalities and your goals of what you're trying to achieve. But what I would say is that you need to make it enough that you're risking so that it's worthwhile, so that it keeps you interested, but also not enough that it's going to worry you. Now, why would it worry you? Well, if you're risking a high percentage of your account on any one particular trade, how is it going to make you feel if it starts heading towards your stop loss? If you're risking 5% of your trade on one particular setup, when you get to being 4% offside of your account, how is that going to make you feel? Is it going to make you start making irrational decisions? Is it going to make you start moving the stop loss because you're fearing taking a loss in that particular trade? As soon as you accept that you're potentially going to lose on this trade, are you going to start making crazy decisions? You know, we've all done it before, and I'm sure plenty of you will still do it again in the future. But at the end of the day, you've got to try and call a day on these things, and that's why within position sizing and how much you're risking on a per trade basis is key. Keep it low so that it doesn't worry you, but keep it enough so that it keeps you interested. The other things to consider is what is your win rate when you trade, and also can you survive any kind of losing streak. Now, we keep a lot of stats here about how we trade and how successful we are with our calls. This is a spreadsheet that has all of our FX trades since the beginning of 2017. We've produced over 3,000, and as you can see there, we've got a win rate of 45.2%, and we've had a biggest losing streak of 7 trades in a row. Now, if we had risked 1% of our capital on each trade over that period, we'd have made 121.5% and seen a maximum drawdown of 29%. So not too bad, positive return, quite happy with that. But how does that change if you start risking higher amounts of capital per trade? Now, just referring back to the poll that we did in our Telegram group, 34% of the people that we polled suggested that they risk between 2 to 5% of their account on each trade. So if we change this to 3%, the gains are bigger, but the drawdown is bigger as well. How can you deal with emotionally losing potentially 70% of your account by trading a higher risk, a higher percentage of your capital on a per trade basis? You might be happy with that, you might be fine with that, it might not concern you. Some of you, it may concern you, may make you want to give up trading or start making, again, irrational decisions. And again, if we up this again to 5%, then it actually starts to have the reverse effect on the P&L overall. The P&L actually starts to drop and the drawdown increases dramatically still. We're talking about almost a 90% drawdown on this particular trading strategy if you had been risking up to 5% of your account. So it might be that a lot of you are running profitable trading strategies. It might just be that you're risking far too much on a per trade basis and it's implicating all of these metrics as a result of it. So do take a step back, do compile as many stats as you can about your trading style and your trading approach, and try and dig a little bit deeper to find out if your position sizing is going to work for your particular strategy. Now the other thing to bear in mind is consistency when it comes to trading, and it's really important that you pick either a fixed amount or a fixed percentage of how much you're going to trade on a per trade basis. I'd urge you not to float around in terms of what you feel like risking. Obviously 19% of the group that we polled said they'll risk whatever they feel like and tend to work on a sort of a gut feel. Now I can almost guarantee that if you have a gut feel about something and start risking higher percentages of your account on that particular trade, you can almost be certain that will end up being a losing trade for you. And the ones that you have less conviction on, the ones you're risking 1 or 2% on, they're going to be the ones that actually go on to be the big winners. So don't have any sort of fixed view on any particular trade. Just keep it consistent, and as I say, don't let any convictions determine your trade size. And another reason for that, these are our trade stats again. We've got a win rate of 45.2%. So we almost have a default expectation when we trade that it's actually going to be a losing trade. So I've got no reason to believe that one idea should be any better than anything else I do. I've got the probabilities here to show me that. Therefore, it makes no sense really to start floating around with your position sizes and your risk. Just keep it consistent and you'll see a much bigger improvement in your trading overall. In terms of your systems, as again I referred to earlier, you can have a good system, and I'm sure a lot of you probably already have good systems, but you're probably risking too much for that system to allow it to actually work. So take that step back and do some more work to understand how your position sizing would work for your particular strategy. So next I'm going to talk about growing a small account. Now I talked about using a particular fixed amount or a fixed percentage. Personally, I'd always side with the percentage, and the reason for that is the effects of compounding gains over a long period of time will have a much bigger impact on your account over a long period of time. Now I'm going to bring the spreadsheet up again just to highlight this point. Here we have £1,000 of capital. We're risking 1% per trade. If we turn that into a monetary amount of £10, then we can see here the fixed line, which is risking £10, and the white line risking 1%. The trajectory of the white line is far steeper than that of the yellow line because we are compounding the gains along the way. So the impacts of compounding will have a bigger effect on your account over a longer period of time. So I'd recommend using a percentage. Therefore your trading sizes will increase when your account size increases and decrease with your account as well. Now the other thing is making regular contributions to your account. It sounds pretty easy, but why not add another £50 to your account or £100 to your account or whatever you can afford on a monthly basis. It might mean that you have to keep out of the pub for one night a week or not go out for a meal one night a week and just eat from the freezer. It's possible to do. Just keep adding to your account, and that along with compounding gains if you're onto a winning strategy will help your account grow much quicker. And the final thing is to think long term. Now I know it's a cliche and people tell you don't get rich quick, it doesn't work. It really doesn't. Think longer term, try and get rich quick, slow. I'm just going to show you again the impacts of compounding and how that could really help your account over a longer period of time. So just using a simple compound calculator, we've got £1,000 in an account. If we believe we can make 5R on a monthly basis, or 5% of your account balance each month, and if you're going to calculate that over a 10-year period, we're compounding those interest on a monthly basis, and we're going to add another £50 to our account each month, then over the course of 10 years you're going to be looking at an account balance of something in the region of 700,000, assuming you don't take any money out and of course you're consistent with your trading. But it is possible to grow small accounts into something much bigger. Discipline is obviously the key. Having an effective position sizing strategy is obviously important as well, but ultimately you do have to think long term, and look beyond the next few trading sessions and weeks and months, and really extend the life of you being a trader by using these tips. So hopefully you've learned something from today. There is some additional learning you can check out. Anything by Dr. Van Tharp is well worth a read in terms of position sizes. It was really something that opened my eyes to the wonderful world of position sizing and how it can make a huge difference to your bottom line. If you have any questions, or if there's any clarity that I can provide on anything that I've talked about today, feel free to drop us a line, an email, join us on our free Telegram group. Of course, we're going to be on YouTube. There's going to be a few more of these videos, as well as some videos that's already there, so click subscribe if you like what you've seen, and hopefully we will catch you again soon. Thanks for watching.